program. It's a keynote by Chris Apfel. He's the founder and CEO of SageMedic Corporation. He's chair at Life Science Committee, Keiretsu Forum, mentor, investor, board member of companies that create value and make the world a better place. Chris, welcome. The stage is yours.
Thank you so much for having me. It's my pleasure to talk today about understanding startup valuation. I think that was alluded to earlier today on understanding is this a good deal? Can we invest? And since we know the answer to all questions, the ultimate question of life or the universe and everything else is 42, right? The Hitchhiker's Guide to the Galaxy. So therefore, I thought I'll give you an overview of understanding the deep math, because at the end of the day, if you really pay attention, you will realize E equals MC squared. And so today I thought I'll give you a brief overview about how to read a cap table and a pro forma cap table. And if you are an investor, how to eyeball your return on investment, get a sense of which variables affect your ROI, and then having a discussion with your entrepreneur you're talking with, arriving at a pre-money valuation that makes everybody happy, because I do think that there are some misconceptions, and I would love to walk you through some of those conceptions. We have actually developed a so-called smart cap table that gives you the understanding of what the return could be for the different investors in the different series. And so what I would like to cover today is, in the next 10, 15 minutes, is a cap table versus a pro forma cap table that we call smart cap table, because we have developed a table with 3 other colleagues that enables us to understand what the ups and downs of this deal are. And then to understand how a simple equity round works. I will talk a little bit about dilutions and illusions, a little bit about simple liquidation preference. We might skip that. But then I will also come up with pre-money valuation or valuation caps, and then with conclusions and Q&A. And I hope it's not only helpful for investors, I hope it's actually helpful for you as an entrepreneur to understand what kind of deal do you want to offer when you are raising capital, and in particular, when you're raising your first round. So normally you get asked, what does your cap table look like? And because most investors would like to know, if they invest, how much will they make out of this? And if you look at this one, the big question is, well, how much money are you going to make? And here we have, these are aggregate amounts of investors into our company at some point. And what you see is how much is available as common stock, how much is Series A stock, which usually has a liquidation preference, how many warrants are outstanding. And then as of 2020 at that time, this was the ownership distribution. And then if we are raising another round, that was for a $4 million round, what would be the percentage of ownership contribution? And the problem with this cap table is it won't allow you to say how much money you're going to make. How much money you're going to make is really dependent on what's your exit value, what's your pre-money valuation, what's your exit value. So I usually ask this question: if your pre-money valuation is now 5 million, your company is now worth 5 million, you invest in this company, and after 3-4 years, it's 500 million. What's your multiple? In the interest of time, I will not ask everybody. So I will tell you that most people who are halfway mathematically inclined will say probably 100x. And so I have deliberately put this as a leading question, because it's 50x. Why 50x? Well, actually, it depends on how much capital you're raising. If you're raising $5 million, your pre-money is 5. Afterwards, your company has 10 million post-money valuation. That means if you're investing 5 million into a 5 million company, the post-money is 10. So everybody owns, the investors own 50%, the founder owns 50%. So if the exit is 500, everybody goes home with 250, which is a 50x. So it's not 100x, it's 50x. Okay, so but sometimes nowadays, valuation, pre-money valuation really are right out of the gate, are 10 million, are 20 million, they are basically twice as high or 4 times as high. And so it's probably not 50x, probably only a half or a quarter. So if my question, the next leading question or misleading question I usually like to ask is, if it's not 5 million, but 20 million, the 50x, wouldn't that then be 12.5x, a quarter of that? No, it would not be a quarter of that. It would be 1 divided by 2.5. So it would be 20x. Why is that? Well, again, because the post money really counts. So it's actually a 25 million post. You, the investor, will own 20%, the founder owns 80%. And then if there is a $500 million exit, there's a 20x for the investor. And you get 400 million, by the way, which is not bad. The problem is not all deals, especially when we think about devices, will actually end up with 500 million. Some will end up with 50 million. And if you start with a pre-money of 20, the exit multiple for an investor would be a 2x. It doubles the money after 4 years, 5 years, whatever. But many deals during this rodeo will go under. That means actually it doesn't justify your investment. And one actually needs to understand, what are those numbers in order for the investor to see, does it really make sense? Does it adjust for the risk the investor is taking? And does it provide the investor with sufficient upside for it so that it makes sense for him or her to invest? So the answer for this question is, it's actually the ownership percentage we have after the investment has been made. And then it's the ratio between the exit value and the post money that we had after the raise. So that's basically your formula that you can use. Now, the reality is you may need more than one round. What if you need 2 more funding rounds? And here is my rule of thumb to you. For one round, it's relatively easy to understand. So how much ownership will I have of the post money and what could be the exit value? That, of course, is a separate discussion, what can be the exit value. But how much will I be diluted if another 10, 20, 40 million are raised? How much will be left for me? And so what I do is I have here a eyeballing. And the way how we do this is normally during an investment round, we expect the company to give up about 20 to 30% of the post money. And that means each round reduces your ownership to 70 to 80% of the original. And so with 2 rounds, you get down to about half of that exit amount. So if you do, let's say, 0.7 times 0.7, so 2 rounds with 30% of dilution, then you end up with 70% times 70% is 0.49. So if before that you were estimating, oh, I can make a 10x, if you know that 2 more rounds are needed, you probably should rather think of a 20x, 10x of a 5x. The challenge is, this is really not that simple. If you really want to know what the implications are, you actually need to map it out. And what I would recommend is that you're not just doing a cap table, you actually spell out the numbers. You say, how many common stocks do we have? How much are we raising under which terms? In how much are we raising? So this is a note that would convert into an equity round. And then you can see how many shares will be issued as a result of those deal terms. That enables you to understand what's the ownership percentage, what is then the worth, the value, the paper value after the round. And you can do this for a second round, for a third round, etc. And then you can actually estimate how much will the exit multiple be at a certain value, let's say half a billion. So this is actually what I did a couple of years ago. And we are still on target. not in terms of timeline, but in terms of multiples. But what I wanted to show you is how this actually works. And this is a tool, if you are interested, I'm happy to share it with you. This is basically the smart cap table that has here this tool. And what you see here is how many shares are in common stock. Imagine somebody is raising 400,000 to get started at a 10 million pre or a valuation cap in a note or as a 20% discount, and then goes on with raising another 4 million at a 20 million pre. Then we end up with this ownership distribution that you see here. You see how much the founders and the employees and contractors have. You see what the Series A have, what the note holder has after the conversion. And then you will see at 100 million exit, let's say, the early stage investor who has put in 400K gets an 8x multiple. You go home with 64 million. And the Series A investor goes home with a 4x multiple. Okay, great. But the majority is really you. Now, what if we need another 20 million? And let's say 10 million or 20 million. And that would then be at a 40 million pre. There is a dilution going on. And unless you really hammer this into this equation, you cannot know what the multiples are. What you see is the Series A gets diluted, even the early stage gets reduced. I spoke about that. And your exit value that you as a founder get, or the founder's team, gets down to 43 million. So dilution is, of course, always a concern. And one of the things that actually is a problem here is, I can tell you right now, with a 5x multiple, it's probably not a good investment. And we could actually add here, for example, add something more. But to keep it simple, what if instead of 10 million pre, we would say 5 million pre? I mean, the founder here in this exit will go home with 43 million. And most founders are very concerned that if they go down here to 5 million, that suddenly they lose all the upside. Instead of 43 million, what they actually will only have is only 20 million. Well, that's actually not the case. And I show it to you. We do a 5 million pre here, and it goes down from 43 million to 41,670,000. And it has to do with if the amount that is raised here is small in relation to the pre-money valuation, the dilution effect for all that are coming down afterwards is actually minimal. But the early stage investor suddenly has not a 5x, has a 10x. Now let's play a little bit further. Let's go down here to 2.5 million. Now we are talking to something that's really attractive. The founder gets diluted to 39 million. It's not much, but the early stage investor, somebody like you and me, would actually suddenly have the potential of a 20x instead of before only a 5x. So what I would recommend is you need to understand, A, what is a realistic exit value? What is the capital we need? And then you can actually use this table to stage out how can we raise this capital in a way. So here there's 2.45. That's not enough. That's not enough for anybody to invest. So this must be, let's say, a 10 million. Then we get here to a 4x. Even that is difficult. So let's say this would be a 8 million. And then you can actually see what are situations where people actually have a good reason to invest in your company. And this is even plotted because there are actually, because of liquidation preferences, which I haven't covered, there are even some non-linearities here. But what you see is the early stage investor who's taking the highest risk can really have a good upside if you are willing to give him really or her favorable terms. And so coming back to the presentation that I was showing to you is, I would like to say, you need to have a pro forma cap table or a smart cap table that's essential so that every party understands the application of the deal terms. Use a smart cap table or do it yourself to get to an honest pre-money discussion. And what you sometimes find is there are founders who says, I don't care whether you do a 5x or a 50x, as long as I make 99 instead of 97 million, I'm fine with that. That's a founder that stops the discussion right there for me. One actually needs to find the happy medium so that everybody really benefits from. Because if you give your investors favorable deal terms that they can have a real upside, then when you need your next raise, when you need some other support, they are on your side. So alignment of interest allows you to have this table with an open discussion. Don't worry too much about dilution. It's about aligning everybody's interest, and be careful about overinflated high pre-money valuation. They used to be 10 years ago, they would need to be 2 to 3 million. And if you look at the World Bank report, the exit multiple at that time on average was a 2.8. And if you do good due diligence, then you can get to a 5x or so. Now the pre-money valuations are 4 or 5 times higher. And now investments in early stage companies is really, really difficult because everybody's centered around these anchor effect of 10 million money pre-valuation. And I think with that one, I wanted to stop here and open the room for discussions.
Thank you, Chris. That was a great discussion and very detailed information for founders, especially on thinking about how much about pre-money and post-money valuation. So when I was growing up, we had a choice. Growing up in India, we had a choice of becoming a physician or an engineer. I didn't like math, so I got into medicine. But now I have to really, really understand this. So thank you for doing all the hard work. And did you say that you were going to share this with everyone?
If anybody who's interested, I'm happy to jump on a call and then give them the table. It is actually a fairly complex table. We worked on that for over a year. There are a number of calculations that run in the background. There are a number of hidden tables. And so some of the stuff is locked, and it would make sense if I give you an introduction before sending it to you, and then you can use it for your own purposes. I would actually require you not to share it without my knowledge, but I want you to have a good tool so that you can have an open discussion and you can really make a deal work so that everybody wins.
Yeah, I would definitely use it. So
sure, happy to share it.
Expect an email from me. All right, let's take.
I couldn't find the hand. Yuli, I couldn't find the hand. Can I ask a couple? Can I say a couple things?
Sure. Go ahead.
Sorry. Wonderful presentation. I've been doing investing for 10 years, and I played with Mike Moyer's grunt table. I recommend that to a lot of founders. And Rocky Mountain Ventures has a pro forma. They also have a social impact, because I do a lot of social impact investing. They have a factorial that goes over it to translate the values into dollars, which is a really interesting piece. Do you have anything like that? I'm just curious in your spreadsheet, which I'd love to have a meeting and get my handle around your smart sheet.
Sure. So one of the critical things is to understand what will be the exit value, and that's a separate discussion. And it has to do with what's your market share. Tell me about when we meet or now, perhaps we can have a discussion about the other tools. I would love to, because I'm not aware of those. So that there may be some synergy here.
Yeah, they created specifically a pro forma. Okay, it was a meeting I went to because we have a partnership. Berkeley Angel Network has a partnership with the Rocky Mountain Ventures in Colorado. and they had an autism startup, so I was interested in going and learning, and they did the whole walkthrough of the pro forma, and they translated the value into dollars. I never got my hands on that spreadsheet. I have the deck from when they presented it, and so I would just love to see if it's possible to get a hold of yours, given that I do all this work, as Yuli knows, with social impact investing, to see how we can have a little elm, part of it can do that. Because, one of the things, I've invested in probably, 40 companies over the last 10 years, maybe more. And I've had quite a few losses actually after COVID for sure, but I've had some great successes. Foresight Mental Health is a big one that I did quite well in. And you call on a lot of things, but I would just, I'm constantly learning. Like, I'll never know it all. There's just so much to learn in this space. I've taken the VC class, and I do what I can, but there's all these new, there's SPVs now, there's all these different dynamics. So I guess if I can work with you to see what we can do, and I'll share the deck that I got from Rocky Mountain Ventures that's about 4 years old now, and it might have an aha for you. So thank you.
Great. Well, what I know in the terms of health economics that I've done, actually, even when I was at UCSF, and I'm still an adjunct professor in the epidemiology by statistics department. I actually think health economics in terms of QALYs is basically the translation from value into dollars in the traditional sense. I've recently heard that QALYs are not allowed for NIH-funded projects to use it as a measure, which is interesting. But the health economics is critically important. So I was an executive director in the at Cadence Pharmaceuticals at some point, and I did a health economic analysis of FERMIF for post-operative recovery for hospitals, and because it was bundled into the anesthesia care, therefore non-reimbursable, and so IV and analgesic. And I've done some meta-analysis on showing those benefits before, and we got our hands on 110,000 cases from the premier hospital network. It's a 550 hospital network here in the United States, one of the largest ones. And we were comparing with propensity score case matched analysis, what are the health and cost implications of this FERMIF, having it or not having it. And we really had identical groups. We found out a $500 difference, and through a structural equation model, we were able to see where do actually the cost savings come from. And within, I think, about 6 months, we were acquired by Mallinckrodt for about 1.3 billion. And Mallinckrodt then tripled the price so that we could make the US healthcare system, again, more expensive and less affordable for those in need, and that we can continue to use our opioids in the fullest dose and don't leverage those alternatives. That's the power of the economics. But I think Margaret had her hands up.
Margaret, go ahead.
Yes, hi. This is wonderful topic. I mean, it's such an important topic that I think a lot of entrepreneurs, Dr. Apfel, miss that. They think, the product is really central and put a lot of focus in the pitch about that, and yet sort of not understanding the thinking behind valuation. My question is, there are a lot of different methods used to evaluate a startup with pre-revenue, especially difficult with those without any money. So what methodologies would you recommend people do for pre-revenue startups? Like there's DCF, there's the VC model. I'm just curious, in your experience, what works, what will work best?
I can tell you what we have done. DCF can't work, right, in pre-revenue. What you can know is you can know what's the market size. You have an idea on the market penetration, and I'm a quantitative guy. I would even go as far as doing a Monte Carlo simulation, where you actually look at all the variables that you have in your equation in order to understand with the tornado plot which are the most important factors that influence your basically your payout and your exit multiple. And you can actually run this if you use from Oracle this crystal ball program, which plugs into the Excel sheet. You can actually understand which of those variables are most important. That is actually in order to actually see where does the revenue go. And once you have the revenue, once you have the profits, then you have a lifetime value of the company in this product. And then you can actually go back and you need to understand how much cash you need for marketing. It's enormous. I didn't know that it is so much money you need for marketing, even if you have
Yes.
the evidence. So I've actually looked up Genomic Health, the S1 reports, and back calculated that and took those ratios. And then you actually know your financial needs. You have an understanding of what the exit value can be. And then you know at which stages do you need to raise how much capital. Once you know how much capital you need to raise at different stages, you can actually plug in the numbers of the pre-money or post-money valuations. And then you can actually see on our smart cap table, does it actually work for the investors? Do the investors have a fair exit multiple that would justify the risk for them investing? That's how we did it.
Very, very nicely put. And Dr. Apfel, I noticed a lot of startups and actually inflating their projections. So it's challenging plugging in the numbers. I found like, okay, you look at the end, right? You look at the number, let's say you use a DCF or whatever methods you use. And I find it's like, is this believable that they will achieve that, right? Based on many different factors. So I would love to talk. I know time is of the essence. I would love to, connect with you after this and get into deeper discussions.
Sure.
Thank you, Margaret. Thank you for that question, and that is bringing our session to an end. So bottom line, Chris, keep the valuation low and don't raise too much money. Does that sound about right?
You need to be realistic, because usually you need much more money than you think. When we started Sage on our own dime, within 2-3 years, we were $1 million out unknowingly. Only when we added up the numbers, how much money we have spent, we realized, and then it actually diluted our savings tremendously. We realized, oh, we need to do something here. First of all, it's very normal, even if you are an expert in the field, to underestimate the capital. Second, when you do a startup that you haven't done before, I even left, when I left my clinical department, I even got a Wharton MBA. But even then, there were a lot of things that you have to actually learn when you do it for the very first time. And it delays this, and it makes it more costly. And so you need more capital. But my suggestion is, for the early investors, when you early start, think about what is the minimum amount of capital you need to get to a good milestone that would then justify a value increase, which would mean, in generally speaking, de-risking the study. So there are technical risks, there are regulatory risks, there are IP risks, etc. And so you need to think about what the first dollars, how can I increase the value, have the biggest bang for your bucks in the first dollars? You raise, let's say, a small amount initially and sequentially, and you start with a valuation that is reasonable, 2, 3, 4 million, or even less, so that the people who believe in you and who support you, that they actually are really partners and carry you through the tough times.
Great. Well, with that note, let's close the meeting. And so the bottom line is, investor is your partner. Make sure they get their money's worth of investment as a return.
Don't be too greedy, and you can map this out. You can map it out, and then you can actually see. So create a scenario where everybody says, "This is great. I can live with that."
Thank you very much, Chris, Dr. Apfel. I think we should do a longer session with you, maybe like a workshop or something, where startups can bring their problems and we can see how you can solve those problems. And thank you.